can't do business without capital, and some capital is more valuable than others. There's an insight. Capital is a value, not a thing. And who decides if it's more valuable? Well, customers do. Like everything else in business, capital is subjective.
This is the Value Creators Podcast. Value creation is the sole purpose of any business and every business, and for all of us as entrepreneurs. Listen to great value creators as they share their successes, trials, and lessons learned. Join us as we explore how to think as value creators, how to act as value creators, and how to view business through the lens of value creation.
Hi, Hunter Hastings here. Our topic today is capital. Defining it, understanding it, optimizing it, figuring out how to account for it in business finance, and how to use it best for business building. Our guest today is Peter Lewin, and he's probably the foremost thinker about capital in business that we have today. He is professor of economics at the Naveen Jindal School of Business at the University of Texas in Dallas. He's the author of Capital and Finance, Theory and History with Nicholas Kachanowski, and also of the definitive volume on Austrian capital theory in the Cambridge University Press Elements series on Austrian economics. Peter, welcome to the Value Creators Podcast.
I'm glad to be here. Thanks for having me.
Well, it's our delight. You're a leading scholar in the field of what we call Austrian capital theory, which sounds a bit wonkish, but you and Professor Kachanowski wrote a definitive modern summary for it for Cambridge University Press. It's one of my favorite books. You've also written a book called Capital and Finance, Theory and History. So you're clearly crossing a little bit into the area of business finance. I know you're not in the field of giving advice to our business listeners, but we are going to talk about some tools that would be pretty useful. A couple of them are free cash flow and economic value added, EVA. We'll mention those. And it all starts, I think, Peter, it does for me anyway, from this idea of flows. Capital is a flow of value towards the customer in a sense. It's supporting a value proposition, which is a flow. And then there's a flow back from the customer, both cash flow and feedback about the nature of the experience, which influences the value of capital. So can we start there? Your perspective on capital value and this idea of flows.
Yeah, well, thanks very much. I think that Nicholas and I have written an important book. And actually, the book summarizes what I think is some important work. But we don't delude ourselves. It is somewhat wonkish. You're correct. Albeit that it has, I think, very important implications. I really welcome the opportunity to talk about it, that side of it. It's not a book that everybody's going to pick up and find comprehensible. I would say it has, and this will lead to answering your question, it has really sort of three distinct audiences. One is the academic community of Austrian economists, particularly that is economists who identify with the Austrian School of Economics. They're not Austrian, but they identify with a particular approach to economics, and has very, very significant implications for them, and they'll sort of eat it up. Or they'll hate it, one or the other. And then there's sort of the academics in general. The book tries to build bridges. The book and the work behind it tries to build bridges between economics, finance, and accounting, and in particular, revolving around the concept of capital. And the third audience then would be the public at large, or more specifically, the business public, and interested lay people, particularly in the implications of macroeconomic policy and how that affects business cycles and therefore how it may affect their particular businesses. So the concept of capital is central. This is a word that is sort of at the center of our very being, right, in so-called modern economies. Industrial and post-industrial economies, we could call capitalist economies, right? Karl Marx coined that term derogatorily, but to describe a new phenomenon of a class of people that basically provided a connection between those who were earning now increased incomes and could save, and those who could then utilize that saving to create value through entrepreneurial ventures. And he called them capitalists, which is built on the idea of capital. Capital, as it originally came into the lexicon, referred to a sort of sum of money or a sum of value at the beginning of a venture that would be the seed for that venture, would be the starting point, would be the ability of the venturer, of the entrepreneur to gain control over, access to resources that then could be combined to create things of value for consumers. Somewhere along the line, that word got obscured. I think Adam Smith was potentially responsible, and he talked about capitals, the individual's capitals, and he slid from the idea of sort of tool which gave you command over productive resources to the productive resources themselves, the farmer's plow, the corn in the warehouse, and so on, that he referred to their capitals because, they had value that was reflected in the value of the business. So the distinction between the actual instruments that we call capital goods in economics and capital itself became obscured. It was very deep into Austrian economics. And part of what we do is to come and try to recapture the old idea of capital as finance. Now, you talked about stocks and flows. The idea that's absolutely crucial, maybe fix ideas. I think your audience will understand if we consider the context of a bill that keeps on coming up in Congress to tax wealth. We all understand what an income tax is. And in a way, we can sort of relate to it. It has a measurable component because income is earned mostly in money, not all. There's some of the tax code covers the idea of sort of non-monetary benefits and so on. You have to put a money value on it, and it could be taxable, not taxable. But the idea is that somehow an individual is using his or her skills, equipment, whatever it is, to earn a flow of value that we classify as income. And the income of an individual in any particular year may be high or low, regardless of whether or not they're wealthy, because income is something that happens periodically, and it really depends on whether the year is successful or not successful. But the individual may have command, or the business may have command over a lot of resources that are, regardless of any particular year, valuable for the long run. So that is a very important distinction between stocks and flows. A stock of wealth is really just that. It is a collection of things that have a value, but its value is, of necessity, speculative, because most of its value depends on how it's going to be used in the future to produce a flow of value to whomever it's being produced for. So when you talk about taxing wealth, it is alarming for many people, because we know if you see a business that's up for sale and a business broker comes in to value that business, if you don't like that value, go to another broker and you get another value. And there will be as many different values of a business as there are people doing the valuation. And they'll use accounting data. But crucially, the value of any collection of resources depends upon how those resources are used. That's what we refer to as the capital value of a business. And it is estimated as sort of what I call the universal value of present value. The way that you put a value on it is how much would somebody pay for it under certain assumptions. So when an entrepreneur pays for a business that has a market value of X, she does so only because she believes that the real value of the business is X plus Y, where Y is some positive number. In other words, that her way of using the resources to produce a flow of value is not shared. Her vision of how those resources could be used is not shared by enough people to value those resources properly, in her estimation. You can see how stocks and flows are related. You're right. It's a flow of value that goes out to the consumer, but that's produced by the producer. I guess just to finish it, is that the resources at any particular point in time are also, you could say, the accumulated value of past flows. Because people may have worked on a field, worked on a building or something to transform those resources into something more valuable. So that work, and those are flows going in, Maybe the best analogy is like a lake. You have a big body of water. You have a waterfall on the top coming down from the hill, augmenting the level of the lake. And then maybe you have a waterfall draining the lake on the other side. So the lake, the level of the lake and the volume of water in the lake itself is wealth. It's a stock. You have income coming in, the flow, and you have income coming out.
Let's add another variable to this, Peter, to the outbound flow and the inbound flow, which I think we can mentally capture. It's got to be calculated, as you said, and that's an estimate. It's speculative. The other element is time. And economists have had a hard time dealing with time. And there's been some controversies in how we add time to this calculation. Can you just reflect for us on how you think about time and how we should think about time in these calculations?
Yes. Time, in some ways, is the ultimate mystery. We strain very hard. As Einstein would be the first to agree, we strain very hard to think clearly about it. But it enters into this particular context that we're talking about in a number of ways. It's sort of in a most mundane way, but nevertheless very significant and in its own way very profound, is the simple idea of the time value of money. So it's just sort of a fact of human nature that people do not value a promise of something in the future as valuable as having that thing in the present. If I give you $100 today, you will value that more than if I promise you $100 in a week from now or a year from now. But I could interrogate you and say, well, I could give you $100 today, but if you let me say I owe you $100, but if you give me another week, I'll pay you more than $100. And then we would find a number, maybe 105 or something. That would be a very generous rate of interest. But that reflects your time preference. That reflects your discounting of the future. Economists have waxed philosophical about the reasons for that and what it means and so on, but we don't really have to go into it. It's not something that anybody will find strange. The future is unknown. More distant future we're talking about, the more things that can happen. People don't live forever. Basically, gratification is preferred in the present than rather the future for a number of reasons, and that you can get is psychological. So that's the first way that time enters into the analysis, and capital is central in that. So a business is exactly that. A business is, at any point in time, or any kind of productive venture at any point in time, is a collection of promises, right? It's basically something that a group of people or a person, a visionary, have assembled and intend to assemble going forward into the future in order to do certain things, some of which may not be clear in its detail. They may leave it intentionally unclear because they don't know ahead of time exactly how they're going to tackle this or that problem or whatever it is. But the point is, it's futures, right? We're dealing with futures. And so when you go to the bank to get your business loan, you present a business plan. And that business plan has what you believe will be the value that you're going to produce in the future. And how do you express that? In revenue. You say, this is what we're going to earn because we're going to produce this many donuts, this many bagels or whatever, and we're going to sell this much on a periodic basis for the next 20 years, and this is the revenue. Well, the bank will look at that, and it will not consider the business to be equal to the sum total of all the revenue that you're going to earn in the future, because it's going to discount the future, and that's called the time value of money. So $105 in the future is not worth $105 today. It's worth less than 105. So in the experiment that I did with you, since that's what you wanted to be compensated, it will only be worth 100. So that's simple arithmetic, again, the universal arithmetic of present value, in which you discount future, what we call cash flows, to bring them back to the present to get the present value, or what we call the capital value of the business or whatever productive venture it is. Well known, I guess, by most people in business.
That's what we're doing when we're calculating net present value, as it's commonly called, right? NPV.
Yes, exactly. Yeah. And I should clarify, I said revenue, but I should have said net revenue. In other words, you have to deduct expenses. I don't say costs, because if you do it for the bank, you include everything that's sort of going to drain the cash from the company in a visible way. But from the perspective of the speculator himself, or the entrepreneur or manager, if they want a good what they consider to be the most important estimate of the capital value of the business, they try and include all aspects of cost. In other words, the best opportunity for the use of their capital going forward, and also how to account for the use of the machinery, the stocks of machinery, buildings, and all that they have. Because if they own them, they are in a sense renting them to themselves. They're getting a flow from those resources that they have to charge themselves. Because you use a machine for a year, it's worth less at the end of the year than it was at the beginning of the year. So that's a cost that the business has borne. That's to get into too much detail. In any case, it's the net present value, the net revenue, correct.
So let's go from there, Peter, to one of the important tools that results from all of that measures the health of a business. We might use that term. I think you do in your book. The first one is free cash flow. So can you just explain free cash flow to us?
There's so many terms. Part of our work, and the third part of this book, comes about because my co-author, Nicholas Kachanowski, whose contribution I cannot praise too highly, he worked in a bank and he came into contact with the consulting group and the consulting methods of the Stern Group, Joel Stern. I don't know him. I know of him. Way back, I'm talking more than half a century ago, when I was living in South Africa, he was an American consultant there and evidently did very well, formed this group, and they developed a method of sort of valuing businesses, of using the accounting data and whatever other data they could get. That is called the economic value added approach. And they distinguish that from what they call the free cash flow approach. The free cash flow approach is just it's just a cash flow approach. It's just the normal net present value calculation that you learn in Finance 101. And I'm not quite sure why it's called free cash flow. I suppose because it means that it's not encumbered in the business. It's available to be used. But it is just the discounted present value of the business using revenues and expenses, tabulated accounting expenses and taxes and things like that. Yeah.
So what's the difference between free cash flow then and EVA, economic value added?
So that was the contribution really that Nicholas brought to the table. The two methods are completely equivalent. But what EVA does, it takes the free cash flow. So we're not using like an visual equation here, but you would have sort of in the numerator of all the components of the cash flow, you would just have the cash flow equation. You would just have the cash flow. So you'll earn $1,000 in the first period, $2,000 in the second period, $3,000 in the first, $1,000 in the fourth, and so on going forward. And then each of these would be discounted more heavily towards the future and so on. Those are the free cash flows. What the EVA does is it breaks up those into what it considers more accurately. It breaks up the profits from those into what it considers operating expenses, if you like, and investments into the business that add to the value. So there's nothing in that sort of normal cash flow. You say you earn this much profit. It will report to you. They normally take the free cash flow analysis and then you look at it. The business is worth this much, but that's not really what people want to know. They want to know what was your profits this year. So they calculate then this well-known figure called net operating profit after taxes, meaning that's just how much of that cash flow is profit. And it's the normal idea of accounting profit. So EVA goes one step further from accounting profit to economic profit. And it says, well, you show that's all the profit, but some of the expenses that you're showing there were actually investments in the business and added to the value of the business. So it breaks it out into what are considered, it's a judgment. It breaks it out into what we consider to be operating expenses that will never be recovered and expenses that are actually add economic value to the business.
So if I've got this right, Peter, EVA differentiates on the cost side between operational costs, which, as you say, can't be recovered, and then investments in the capital value of the company.
Right. And there's a judgment there. For example, how do you know when a business has failed, right? Negative cash flow, even for a fairly significant period, may not be sufficient to render the judgment that the company has failed. I haven't examined the data, but I remember, because I'm old enough, Amazon not posting any profits for an extended period of time, not posting any accounting profits. And I remember thinking that was in the sort of heyday of new internet economy, and there was a shakeout. There were so many companies that couldn't and didn't make it, and I was very surprised that Amazon just kept on going year after year after year, seemingly plowing money into this business. And you begin to wonder, where's it coming from and so on. But I think if we examined that in more detail, what was happening is they probably had a healthy cash flow, fairly healthy cash flow. And what they were doing is they were investing it in the business, putting it back in. The powers that be saw the vision that Amazon could become and has become. And basically that 10 years or so that was really pivotal in getting the company up to scale, because it's a huge scale, to earn and create value the way they have now that we expect of them. I know of a company, maybe I shouldn't mention the name, it's a private company, but it's very well known. It has not yet posted profits. It's a tech company. It's, I would say, medium-sized company by today's standards. Donors or investors keep on pouring money into that company because in their judgment, what's happening is economic value is being added. And when they reach the scale that they need to reach and when the public or the name recognition and everything, then it's going to explode. So economic value added tries to make this distinction and it's sort of from the point of view of a deep examination of the company to, I suppose, advise the decision makers whether or not they need to do something different in terms of investing in the company and so on. And then, as I assume you're going to ask me, it also has things to say about trying to diagnose where the value is coming from in the company, what they call the so-called value drivers.
I just wanted to reinforce what you said. I've heard Elon Musk, who intentionally says things in an extreme fashion, say that profit's a bad thing. Profit's just the money that you haven't invested in future innovation.
Ah, yes. Interesting.
So investors need profits, periodic profits in a year or a quarter, whatever it might be. But Bezos and Musk are thinking about the long-term future and how much they can reinvest in growing those businesses. So you've just said something really interesting, which is super helpful, which is this idea of value drivers. The model I have in my head, Peter, is that you can break down the capital into components and try to figure out which component is driving more value or has potential for more value than another. Is that accurate? And how can we do that?
Yeah, that's exactly accurate. You break it down in terms of both costs and revenues. And it's, again, a judgment call. So it depends on the business and it depends on the context. I guess a multinational, you would look at different regions, different locations, particularly if we're talking on the consumption side, different markets. I mean, this is not new, but it's a way of sort of organizing the data that you have and the data that you project into a judgment about which locations are giving you sort of what proportion of value. And you can do that also for the costs. It's a different kind of examination. You can do that also for the costs because in different regions, if you're just talking geographically, there are different factors. You want to break out how they affect the big picture of the company as a whole. And so this is kind of it's a model giving some basic arithmetic, some basic mathematics for how to do that. And we have a chapter on that, but it's basically mirroring this particular approach of this consulting group to it. But the spin-off is that it also addresses the academics because there's that big problem in economics about sort of how do you know how much of the capital value over time or the economic value coming out of a venture over time, how do you know what that's due to? How can you tie that to something that occurred earlier and also to something that occurred earlier and to specific contributions that occurred earlier? It's very important because, I mean, think of this question of what is a job worth? Well, an employer supposedly and should supposedly pay a worker what they add on net to the value of the business per period. If I'm paying somebody $5 an hour, I won't hire them unless, in my judgment, they add more than $5 to the business. because I know they're going to increase my cost by $5 an hour. So if they don't add more than $5 an hour to the business, why should I hire them? I'd be hiring them at a loss. But how do you know what they add to the business? That's called the imputation problem in economics. It doesn't have a solution, but value drivers is a kind of a pragmatic solution to that.
One of the places that I relate to that from my background, which is marketing, is advertising or marketing campaigns as a driver of brand asset value. And I remember Stern Stewart talked about brands as big builders of EVA because they're intangible assets that have future cash flows associated with them. So how do you decide whether advertising is a cost, which is what it usually looks like on the P&L, versus an investment in a future asset?
Exactly. I couldn't have said it better. Yes.
So that's a judgment call?
Yeah. And not only that, it's unprovable because it always deals with what might have been.
The battle between the chief marketing officer and the chief financial officer.
Yeah. You use your best judgment because you look at best practices and you say, look at these guys. They did it this way and they're doing fine. And these guys, they did it this way and they're not doing fine. And I think we should do it this way, that kind of thing. But at the end of the day, you can't rewind time. It's just another way in which time enters into the analysis. The counterfactuals, right? You're the marketing guy and you say, listen, if we hadn't done this, or if we had done this,
If we
and the
had,
chief
right.
financial officer says, so you say,
Yeah. Yeah, that's the Austrian way. You can't predict the future of your marketing campaigns. So one of the places this all intersects a lot for Austrians is not at the firm level, but at the monetary policy level, Peter. All this conception of flows and time. And Austrians say that if you fiddle with the interest rates in an artificial fashion, that affects what we might think of as the EVA of the nation or of the GDP, that we start to make wrong calculations about those future cash flows and the return on capital and so on. Just take us there quickly. How exactly does this fiddling with interest rates cause entrepreneurs to make errors in their business calculations?
You characterize that very well. I spoke earlier about the time value of money and discounting. The discount rate, it's a kind of an interest rate. It's what we think of usually. It's an interest rate. So individuals may have their own personal discount rate, but in financial markets, for example, particularly in the valuation of financial assets like bonds and bills and loans and so on, people well understood interest rates or discount rates to value these. And their access to cash, for example, will depend very much on that, on the present value of something as discounted by some market rate. And when those rates go up, then the value of all durable assets goes down. Now, all durable assets, not only financial assets. Financial assets go down in a very predictable and sort of precise way you can calculate if you're talking about market value. But the value of all durable assets goes down when interest rates go up, and that affects discount rates. So that's most prominently, for example, houses or any kinds of buildings. I mean, any durable asset, because any asset is a stock of wealth yielding a flow of services, valuable services. So that have to be discounted to give the value of that asset. So when the interest rate, for example, goes down because policymakers think that that will boost the economy or something, Mises and then later Hayek used the idea of capital value in that way, although to be sure, I don't think they were precise enough about it, and that's a lot of what our work is about. They understood it, of course, 100%, this idea that basically the interest rate goes down, so it's these certain assets are going to appear more valuable than they were at a higher interest rate. And this is going to be more true the longer the term of the asset, what we call the duration of the asset. A house, the value of a house will be more affected by a 1% increase in the mortgage rate than, say, a treasury bill by a 1% increase or decrease in the federal funds rate or something like that, or the treasury bill rate. So one is a very short term, maybe 9 months or something like that, and the other one is in years. So we refer to this theoretically as the interest elasticity of present value, the percentage change in the present value as a result of a change in the interest rate. So the Austrians made the argument that if enough people can be affected by a manipulated decrease in the interest rate, they will be influenced to invest in longer term. That's something that needs to be investigated, how we know what we mean by longer term. But if we do, they will invest in certain investments that they would not otherwise have invested in. There's a threshold, and that threshold will be pushed back, meaning that resources will flow into unsustainable investments. And then when it becomes clear that that interest rate was artificially pushed low, those investments being unsustainable will then fail in whole or in part and will have to be undone. That's what's commonly referred to as the correction.
Yeah, the bust.
So that sort of in a nutshell is the assertion.
Let's go back to the firm level for our summary, Peter. I know you don't give business advice, and this is not intended in any way as that, but I want to say, boy, it would be smart for business owners and business managers to get intelligent about EVA, to understand economic value added, to understand their value drivers, to make that calculation about the duration of those flows, and really work hard at understanding that to build the capital value of their business. Is that a proper thing to say?
Yeah, the reason why I'm sort of not, I'm under no illusion about my ability to give business advice is because the people who do that best are those who do that best. In other words, the people who sort of in the businesses, they may not even know what they're doing. Jeff Bezos know that he was engaging in economic value added. Maybe a Stern steward or whatever came and gave him advice. Maybe they did, maybe they didn't. Or Musk. At the end of the day, they are their own advisors, right? They'll get as much information as they can. But what they're really doing is they have this vision and they're looking at the actions within the firm and they're saying which they believe will be beneficial for future value of the company. That's what entrepreneurs are doing. CEOs, decision makers are trying to maximize the capital value of the business. And they may get it wrong and they may get it right by accident. There's no formula. If there were a formula, I wouldn't be sitting here. I would probably, be making a lot of money and have retired. So I think it's more descriptive than prescriptive. But yeah, I mean, maybe that's what we can teach students in a business school, that this is what the people who get it right are doing. And if they can take those categories with them into business, they will have a better platform, they have a better foundation from which to look at things.
So, Peter, let's see if we can connect those two things. The businessman or business person trying to calculate their EVA and their value drivers, how they make mistakes in the macro context when interest rates change because they're manipulated by the Federal Reserve and monetary intervention. How do I put those two things together?
Yes, and that's an interesting question because if the Austrian model is so plausible and that the economists believe it and understand it, then why do the business people not? And why are they fooled by the fact that the interest rate is being manipulated? I mean, the story is that the low interest rate, the Fed pushes the interest rate too low to reflect the real availability of resources. And basically that prompts, because business people don't realize it, that prompts investments that are unsustainable. Well, why do business people go in and make unsustainable investments on the basis of information that they should know is false? And it's a fair question, but there are a number of answers, really. Two in particular. One is that they may know, but they may also be prepared to take the risk, to ride the wave of the cycle, and then hope that the downturn doesn't affect them as much. The model typically is presented in macro terms, whereas people actually live in micro terms. They're making decisions about their own particular business. And so they're looking at their own particular slice. And for example, in the dot-com boom and bust, everybody knew that book values were very much overvalued, and they knew that it had to come to an end eventually. They also knew that Alan Greenspan was pushing the boom this to sustain the boom as long as possible. And people were investing in these companies on the stock market and elsewhere just as long as market values were rising, even though they knew that eventually they may come down. Sort of people, as much as they're told they can't time the market, do try and time the market, and some of them get away with it. That's the one answer, the difference between the micro and the macro. It's what people don't act on the basis of macro models. They act on the basis of the information that they get, some of which they may believe and some of which they may not. Another interesting aspect of this is the way that it affects fixed income assets. And I'm thinking of the failure of Silicon Valley Bank and similar situations. So in this situation, we had really decades, but certainly years of monetary mismanagement, trying to avoid and in the process eliminating cycles and downturns. And as a result of that, the liquidity position in financial markets was affected dramatically, and banks found themselves in sort of an absence of profitable opportunities, very low interest rates, profitable opportunities for their investments. And then the Fed sort of came in and kind of guaranteed them they should invest in government bonds, long-term government bonds, and they will be all right. And companies like Silicon Valley invested heavily in these bonds at very low interest rates, sort of under the assumption, I suppose the assumption, we'll be okay. These are government bonds. But there's a absolutely known calculable risk associated with that, and that is that the value of these things will be severely undercut and any kind of austere monetary value comes along and interest rates come up. But looking back, don't we say, what on earth were they thinking? But they were doing, I guess, what the Fed advised them to do. We're making these profitable opportunities available to you.
Well, also the regulations force them to mark those to market. They can't hold them to maturity and say the value hasn't changed on the balance sheet. They've got to mark them to market.
Yeah.
In the short term.
Right. But that, in a sense, is an aspect of an Austrian cycle, is it not? Yeah.
Right. Absolutely. We were going to talk about a sports analogy, and I forgot to cover it. I'm a big soccer fan, so what's happening in European soccer right now is really interesting, that a number of wealth funds, and hedge funds are buying soccer franchises, putting enormous amounts of money on the expense side to pay high wages and acquire players on the bet that those franchises will increase in capital value over time, and they'll be able to sell them for a lot more than they paid for them. So my local soccer club in England was acquired by the Sovereign Wealth Fund of Saudi Arabia.
What club?
Newcastle United.
Ah.
They've improved the financial performance of that club enormously in a couple of years. They expect to continue to do that. They paid about $300 million for the franchise, and I'm sure they'll sell it for $5 or $6 billion sometime in the future. They're looking for 10x, they said. So that's EVA, right? The cost
yes.
of paying the players is an expense, and the value appreciation is EVA.
Big time. So yeah, sports analogies, and in this case, it's an actual case in point. That's an interesting example that I didn't know about. An example that has caught my attention recently, you may have seen. Lionel Messi has gone to Inter Miami. And Inter Miami is not a particularly good team, even in the Major League Soccer of the United States League. And he turned down a $1.25 billion, apparently, reportedly, offer to go to Saudi Arabia. And apparently his deal is he has a share of the profits, and he's underwritten by Adidas. I forget so Adidas was the one, as I'm talking, I can't remember, but the other sponsor of Inter Miami. So he regards that, first of all, probably he didn't want to go and live in Saudi Arabia, preferred to live in the United States. But secondly, the deal that he's got in terms of he actually a player now sharing in the profits of the club, of the team, and then of their sponsors, their donors. His discounted cash flow, economic value added, discounted economic value, by the way, which is called market value added, MVA, is probably worth more to him than the $1.25 billion in Saudi Arabia.
Right. He's going to become a part owner of the club, is that right? So that he'll benefit from the franchise value increase?
I think so. I don't know how that squares with the conflict of interest and all that, with the coach and everything. I'm not sure, but that's my understanding. The details will be revealed.
There's a whole new field that's growing up called sports economics, Peter. I think it's got its own journal now, and it's a whole field of study. So you and I can have fun getting involved in that. Well, we'll urge people to read both of your books, yours and Professor Kaczynowski's books, Austrian Capital Theory and Capital and Value, Theory and History, and think hard about EVA, about building the asset value, the capital value of their firms. So thank you for today.
Okay.
Good.
Thanks very much.
Thank you so much.
You're very welcome. Nice to see you.
This has been another episode of the Value Creators Podcast. Thanks for listening. You can visit thevaluecreators.com for links and resources related to this episode, and check out hunterhastings.com for more content on entrepreneurial business management based on value creation principles.